Welcome, everybody, to Martinis with Scott, a show about winning momentum in life and in business. This is episode 76. I believe we are on, you're probably watching us on YouTube or listening to us on Apple Podcasts or Spotify. If you like the content, please subscribe. I forgot to say cheers. I hope you all have had a great week and enjoy your beverage. I hope you're having a good martini. This is a rare morning show, so I'm on coffee. I'm recording this in the morning. Usually I try to get it done on Wednesday evenings. I have a martini that I get to share with you, but it took me too long to put the content together this week. Sometimes, if I have a guest on the show, which we'll be getting back to now that summer is over, we're going to have a couple more guests coming up in the future here in the next few weeks, I believe. But if I have a guest, it takes me maybe 10 minutes to prepare for the show. It's really, really easy. And most times if I've had a week that has raised some issues for me, then I know that I can talk about it on the show. It might take me half an hour to prepare. And sometimes it takes me forever to prepare for the weekly show. And this has been one of those weeks. I spent really a good chunk of yesterday and some of this morning getting this content together. And the good news about that, that just seems crazy to do a weekly show for someone with my schedule. But the good news is it's actually because I'm thinking about issues. I'm thinking about issues within my businesses and I'm arriving at conclusions. And only then can I actually have a discussion with you about these issues that I'm trying to work through and what lessons that may have for all of us, including you in your businesses. So all of that to say, I didn't get this done last night. So I'm having a coffee, and I hope you're having a wonderful drink at Thursday, 4 p.m. Eastern. All right, let's get on with it. I want to do a quick, maybe not so quick, but a look back a couple weeks ago to the Goodyear tires issue. And if you missed it, I'm going to review this again, the entire issue. And I'm trying not to repeat myself. I'm trying not to, don't worry, I'm not reusing old content, but there is a point to this. There's an update to this story. And there's an update to how you may deal with this particular cancel culture, social justice issue within your own business. I thought you might find it interesting. So if you missed the show a couple of weeks ago, obviously you can go back and look at it. But Goodyear Tires is a U.S. and American manufacturer out of Akron, Ohio. Been around since 1898. They own a couple of brands. Goodyear, obviously, also Dunlop tires. They trade on the NASDAQ, and I'll get back to their trading, not an issue, but just where they're trading at in a minute here. So on August 18th or 19th, so call that 2 weeks ago, a slide leaked out in social media. I saw it on Twitter from some sort of training session somewhere in Goodyear. And the slide was broken into a table with two sides. On the left side was acceptable, on the right side was zero tolerance. And the bullet points under acceptable were two: Black Lives Matter and lesbian, gay, bisexual, transgender pride. So LGBT pride references were acceptable at Goodyear, or at least in wherever they were doing this training within Goodyear. And so the idea was you could wear a hat, you could wear a t-shirt, you could talk about, you could write about anything that supported Black Lives Matter or LGBT pride. Okay, that was acceptable. Zero tolerance. Blue Lives Matter, so supporting the police. All lives matter. So that would be the typical comeback from somebody who thinks that Black Lives Matter is in fact a racist mantra. People would say, no, all lives matter. Everybody matters equally. And so that's unacceptable. Zero tolerance at Goodyear. MAGA attire, the Make America Great Again, President Donald Trump's election campaign saying, or logo, slogan, I guess is the word I'm looking for, and any other political slogans and attire. So those are on zero tolerance, but the Black Lives Matter, which I assume would include the riots and the looting going on throughout the U.S. in the left-leaning states and cities, I assume that includes that would be acceptable at Goodyear and the LGBT pride stuff. So that, of course, kicked off a firestorm on Twitter with a hashtag #BanGoodyear. I read you a couple of tweets. on the last show that we did this a couple of weeks ago, but one of them was from Trump that said, "Don't buy Goodyear tires," all in capital letters. They announced a ban on MAGA hats. Get better tires for far less. Bracket, this is what radical left Democrats do to can play the same game, and we have to start playing it now. Explanation point. And there were two sides on Twitter. Obviously, a lot of it was banning, but there were some saying, hey, my tires need replacing. I'm going to a Goodyear store right now because I agree with what they're trying to say politically in their training sessions. And then I suggested on the show that I wondered whether this leak of this slide was really a leak. What if they did it on purpose? And we went back and we talked about Colin Kaepernick, the football player who became famous for taking a knee during the U.S. national anthem, was reportedly paid $39 million by Nike to do a series of commercials with the Believe in Something, the Believe in Something campaign. So it was taking a stance on social justice, whether you believe in it or not, but it was highly lucrative for Colin Kaepernick, $39 million. And obviously Nike was willing to spend that money because they believed in this sort of advertising and that alienating a good chunk of the country would not really hurt their brand or hurt their revenue or hurt their market value. Same with Gillette, who a couple of years ago, it feels like a year ago or 2 years ago, did the toxic masculinity series of ads, which, notwithstanding they sell largely to males, they told all males that they're toxic, their entire target market. And obviously they spent a lot of money on that and felt like that would be a good campaign to help their market value and their revenue and their brand. So I wasn't saying that Goodyear did it on purpose. I'm just saying that if they did, maybe it was brilliant, right? Because they got the same attention that Gillette got and that Nike got for $39 million to Colin Kaepernick, and they got it for free. They got it for absolute free by leaking this slide on Twitter. And what is the very first rule of persuasion, of sales, of brand building? What's the first rule? Is attention. If nobody's listening to you, you can't do anything. They got that, and they got it for free. So if it was on purpose, maybe it was a brilliant strategy. So what's happened in the last 2 weeks to Goodyear? Well, near as we can tell from public markets, absolutely nothing. Prior to this leak 2 weeks ago, their stock was at $10 on the leak and the social media storm, and it was a storm. Stock dropped to about $9.50, so not too bad, 5%. And when I looked yesterday, it was trading in the high 9s to low 10s. So really unchanged from where it was before this storm and the whole ban issue occurred. What do public markets tell us about the perception of value and future revenue and whether an advertiser works or not? Well, it tells us what people believe. For sure, when this storm happened, people being sophisticated investors, it tells us what they believe. So for sure, when this happened, there would have been analyst calls into management that would have said, hey, what's going on? What are you going to do about this? Are you going to do anything? Are you going to fight it? Are you going to come out with an apology? How are you going to handle that? How is it going to impact revenue going forward? What are you hearing from your distribution partners? All that sort of stuff. And clearly they were satisfied with the answers. And there was never really an apology from Goodyear. There was an attempt to skate around the issue, right? Saying, hey, that's not really what we believe. And this thing just leaked out. Who knows? But the bottom line, it hasn't hurt them. And we'll never know what the revenue impact was, whether people stopped buying Goodyear tires or bought more Goodyear tires, right? Unless there's some sort of massive decline or massive gain, 20, 30%, which just I highly doubt is going to happen. The way quarterly reporting works, we're not going to know. We're not going to know for another quarter what their numbers are, and then we can't believe them because that could be stuffing the channel, could be cleaning out the channel. So really, the true numbers are going to come 6, 9, 12 months from now, and by then so many things would have happened. You can't attribute it to this particular instance. So it appears on the surface like our best metric to see what this what the fallout from this so-called leak would be the stock market, and stock market is unchanged, which is what I told you on the show. Don't be afraid to get attention. Don't shy away from this. And here's why we reviewed, don't shy away from this issue. And here's why we're reviewing this week what we all reviewed 2 weeks ago, is because I told you at the end of that the interesting part to me of this story is that all of you that are running a business or that are in a business, you're going to have to deal with this issue. This is the modern era. This is the issue of our times. And what happens? What happens when somebody externally comes to you and says, hey, there was this social media post. What are you going to do about that? Offends me. What are you going to do about it? There's a leak from your company on social justice type things, and we're going to cancel you. We're looking, I want this employee fired, or I'm going to ban your products. This is happening. Don't put your head in the sand. You need to think about it, and how are you going to decide what you're going to do? And what I suggested to you is two things. You need to ultimately make a decision based on your values in this area. But you also don't be scared of the attention, okay? Don't be scared of corporate virtue signaling, which is effectively what Goodyear was doing. Even if it's not 100% on side with where you want to go as a brand, because attention is everything. If no one's listening to you, then you can't accomplish anything with your brand. And certainly Goodyear was able to get people to listen to them for that short little period of time, a couple of days that storm went on. So I told you need to have a position on this. Look to your values to decide what that position is, but don't be fearful. That was the bottom line. Don't be fearful of the issue. If you want to embrace this, embrace it, because it gets you attention, and that's really, really important when you're trying to build your business and brand. I told you on the show where we covered this that I need to do the same thing. I need to think about it because I had not thought about what I might do if this ever happened. Here's why we're covering the topic again today. About 3 days after I did that show, I had my first cancel culture threat, so to speak. You can decide whether you think it was a threat or not. So a little bit of the backdrop here is I run a hemp processing facility in the U.S. It is a startup. It's going pretty well. I'm not the owner. I'm not an investor in this company. I'm a figurehead in a sense that was helping with corporate structure and some of the initial partnership issues and funding issues that the company was happening. And we've got all that sorted out, and things are going fine, and we got great management on the ground. But I remain as I believe I'm sole director. Well, I know for a fact I'm sole director and president of this company, even though with COVID, I'm sitting in Canada, it's in the US. I just haven't been there in a long, long time. But obviously, we talk to them every day and manage it like I manage the rest of my companies and client files. And so we're in industrial hemp processing. We're in the US. And as I said, a couple of days after we did the Goodyear show, a fellow by the name of Thomas Holland emailed me privately on LinkedIn, and since he seems to be such a social justice warrior, I'm sure he wouldn't mind me promoting his personal brand and concerns with my people. So Thomas Holland, according to his LinkedIn, is a home care national account sales analyst. Home care national account sales analyst at Medline Industries, Inc., which appears to be out of Chicago. Medline appears to be a big company, of which this Thomas Holland fellow is an account sales analyst. And if you surf around a little bit on Mr. Holland, he appears to spend a lot of his time at work actually posting and discussing social type justice or left-leaning or extreme left positions on his social media, including his LinkedIn, which I would have thought was more of a business oriented social media platform. So instead of working on his Medline Industries business, I have no idea what he does in his real job. Obviously, he spends a lot of time on this, and he emailed me on LinkedIn, and here was his email. It says, I hope that, I'm not going to tell you this person's name, so let's call her Jane Doe. I hope that Jane Doe's activities here, making fun of children, does not represent your company. Might want to involve yourself in the kind of messaging she does on a professional network such as this. As a manager, I would think such a position would require a little more forethought on how her actions represent herself and the company she's with. So this is an email to me on LinkedIn out of the blue. I've never met this Jane Doe, by the way. She was hired recently at this company. And I had no idea what this Thomas fellow was talking about, so I emailed him back and said, you're going to have to give me some context. He said, surf for postings on this site, being LinkedIn. I said, no. If you're offended, you need to tell me specifically what it is. And so he did. He provided me a link to this. And what it turns out is that, much like Thomas Holland himself at Medline Industries, I also have an employee who likes to spend some time during the day posting on her social media sites things that she believes are important or her views on these social justice issues. So the topic was global warming, that this group of people, it wasn't just the two of them, but it was global warming if I look through it quickly. And my employee posted a meme for you older folks that are listening, like my mother. A meme is just a picture with a funny saying over it, and it was a meme of Greta, whatever her name is, Thornburg, someone can correct me on that, saying something about, and then the funny caption over it was something to do with, communism is the answer kind of deal. I don't remember the exact, I don't really care. I do remember thinking to myself, Greta is not a child. And so if you're going to accuse me of making, or my company or my employees of making fun of children, I would take that seriously, but there ought to be a child involved. And she's not a child. And also, I just, for the record, would say that if you put yourself out as the I don't care what age you are, if you or your handlers put you out as the spokesperson, the global spokesperson, to persuade and to guilt and to accuse other people of doing the wrong things on your particular issue, in her case, global warming, there's going to be some pushback. That's probably fair, right? I mean, if you put yourself into the arena, you can't then say, don't talk about me, don't make fun of me, don't question what I have to say. I'm a kid. That doesn't work. That doesn't work. My personal view. So what is my response? What is my response to this issue? I told you it's going to come up in your business. It came up in mine like 3 days later. So I didn't know what to think, and I was I was really wondering why my Jane Doe is posting these personal things and taking positions and putting memes on LinkedIn that have nothing to do with work. I called my U.S. attorneys just to get their view on the state of the nation. I'm not to do anything, but other than to give me advice. What do you do? What do you do when you're, this size of company? We're not Goodyear. We're a medium, small size business. What do we do when an employee does this thing? Should we have a policy on it? What is the state of the nation? I called, a couple of attorneys actually, and I called some banker friends and some company owners, and to my surprise, nobody had an answer. So nobody's really thought through this. And what I came up with on my own as a tentative plan, which every one of these people in the U.S. that I talked to thought made sense, I came up with this. If you are posting, so if you're related to any one of my companies in the world that I'm working with, if you are posting on a platform such as LinkedIn that refers to my company, right? So it says, hey, I work at Sinclair Range, or I work at whatever other companies I'm involved with. If it refers to my company, then 100% of your postings need to be about business, and that's zero tolerance. So you shouldn't be posting about global warming on a platform that refers to the company. If the platform is something that doesn't refer to the company, say your Facebook or your Instagram or something, as long as it doesn't refer to the company, then do whatever the hell you want. But I reserve the right, if you bring embarrassment to the company, in other words, if somebody looks through this and starts accusing us of, the business of being associated with this, which we would not be, but if we're accused of that, I reserve the right to, to terminate you or take some other action as an employee. That was my immediate reaction, having thought through it for about a week ago, and talking to people, and so much was it my immediate reaction, or my thought through reaction, that I called the U.S. attorneys and asked them to check that with their employment lawyers and to start drafting up a policy to that effect. And my intention is to give it to all employees and just have them sign off on it, so they acknowledge that that, on your own stuff, do whatever you want unless it causes me trouble. And on a business platform, talk about business. Everybody I talked to thought that was fair. So I started preparing for this show yesterday, and I started looking at the Goodyear thing again because I was curious what had happened to their stock price. And as I said, I found nothing happened. And as I reviewed my notes from 2 weeks ago, I went back to my advice that I gave you and that maybe I wasn't listening to. I said, don't be afraid of attention. Don't be fearful of this issue, and to follow my values when I decide what to do about this. And I thought, am I being fearful of this issue? My immediate reaction was to put a stop to it. I don't know why. I don't know why it caused me to do that, but my immediate reaction was to put a stop to it. I think I was being fearful of the attention, the negative attention that this might bring, which is the opposite of what I told you to do. And then I thought, well, what are my values on this? And here's what I came up with. I believe in freedom of expression. I don't want to direct employees or anybody else's. I don't want to dictate what they can speak about and not speak about, what's important, what's not important to them, what are their views on the particular side of that issue. I think people need to be able to communicate. I think that's part of being a human, and I think it's what's really lost in this society, particularly on the left, is this faux elite, hate-driven, totalitarian, speech monitoring crap that they have going on. Is the biggest problem in the world today, and so that's not my values. My value is to listen, to be empathetic, and to let people express themselves. One of my values is to be practical in business and in life. Like, what am I going to do? Am I going to write this policy and then sit around and monitor people's social media accounts to see that they're paying attention to it? And what if I don't? If I don't do that, and then a year later, another Thomas comes through with some weird kind of complaint about a meme that's offended him, but I haven't been holding people's feet to the fire until it was brought to my attention. Is that a fair monitoring of my own policy? I value attention. I value from a persuasion perspective in business. This is not a personal issue. I don't value attention at all. I hate attention personally. But in business, you need to have attention. People need to know who you are. Otherwise, you can't build your brand and you can't sell to them. So I value that from a business perspective. But here's one of my biggest things right now is most of all, and this is on the negative side, I just hate whiners. I hate whiners. People that have nothing better to do in their lives than to be pissed off at a stupid meme. And that politically is what drives me the most. It's not, so people say, well, you're a conservative. I'm not a conservative. I've talked about this on the show before, and I try not to talk about politics much, but I lean towards voting conservative. I consider myself more independent and pretty left and pretty liberal on some issues. But what I am mostly is against as I said, the full elite, hatred-driven agenda, which defines the left and defines the Democrats today, and defines Thomas, what is his name? Go back and make sure that I get this right. Thomas Holland from Medline Industries, okay? So those are my values. So is the policy that I was about to implement in line with my values? No, it's absolutely not. And I got that I came to that conclusion preparing for this show, which I think is pretty cool. When I tell you that I have to think through things sometimes to be able to prepare this content, there's one thing that I had to think through. So I changed my mind last night. I'm not going to monitor people's social media accounts, Thomas. I am not going to let other people influence how I deal with my employees. I will stand up for my employees and their right to express themselves and to think whatever the hell they want to think. My policy is that they can post whatever they want within the guidelines of that particular platform and within legal limits. That is the policy. It is the policy throughout every company that I have the opportunity to influence this policy on. And I actually called the investors of this particular U.S. company last night, and I told them, I've changed my mind. This is what I'm going to do. And after about a half an hour discussion, everybody was on board with that. So Jane Doe, you're off the hook. Do what you want to do. Thomas, piss off. That's the new policy. All right, let's move on to Novanni Stainless. If you're new to the show, we've done 7 episodes on the turnaround journey that is Novanni Stainless, a Canadian manufacturer of stainless steel sinks. Great little company. It's a company that Sinclair Range, the company that I am president and own the majority of, actually all of it now. So Sinclair Range bought Novanni Stainless in late June of 2020. So I am now president of Novanni, and I've been so effectively 2 months into this. I consider July being my first month. And on the Martinis with Scott channel, if you want to go back and see the whole history of this turnaround journey and some of the issues that I have been going through in trying to turn this once troubled company into more of a success. A company with a great history, by the way. It was a success long into the past, but for the last several years, it's had significant trouble. Anyways, so this will be, I think, our 8th update on this, something like that. And one of the things that you'll learn if you go back and listen to the past content on this story is that when I bought the company in June, the company had no financial statements really for almost a year. So around July 2019, the controller in this business left, and the rest of the staff did their best to try to keep their fingers in the dike, so to speak, and do a bunch of journal entries, make sure they knew what they owed people, make sure they knew what they needed to collect from people. But a lot of things were not reconciled. Really nothing was reconciled, including the bank statements. So it made it really difficult to do due diligence. It made it really difficult to do any analysis. I've hired staff at Sinclair Range, which is now the 100% owner of Novanni, to try to bring this all together. And it's been a long process, several months of getting these books and records cleaned up, but I'm now starting to get some real numbers in. I got reporting for July a couple weeks ago. So like third week of August, I got some July reporting finally. And I had an idea of what June was before that. But when you start curing, if the accounting was wrong in January 2020, and you get around to fixing that in June 2020, do you go back and restate January? No, that's just a waste of time. So you plow everything into June in that example. And so your June numbers are crap because they're not related to just June. They're related to prior periods, as we would call it in accounting, or even to 2019 prior periods. And so it's hard to look at those numbers and say, okay, here's some interesting decisions. That is starting to get fixed, and it will work its way through the system and into September, October, November. I think the reporting will become more regular and it will be more accurate and more reliable. But I've got some early numbers, sketchy as they may be. I've told you on this show before, it's a topic that we discuss a lot on Martinis with Scott, the formula for making money that I want you to focus on, that I try to focus on. So think of it this way. Your profit is equal to the revenue of the business times the contribution margin in percentages minus your fixed costs. Okay, contribution margin is your variable costs, right? So revenue minus your variable costs minus your fixed costs equals your profit, okay? I do it as a percentage, so revenue times your contribution margin percentage minus your fixed costs equals your profit, all right? So how do you make more money? Well, you improve your contribution margin percentage, right? So contribution margin is for every dollar of revenue, my variable costs are, call them 40 cents, and so my contribution margin is 60%. So for every dollar of revenue, I get to keep 60% of it to pay my fixed costs and my profit. That's what a contribution margin is, okay? It is not a gross margin. If you're running a business and you have a gross margin, which is how accountants report their financial statements, gross margin is revenue minus direct costs. And direct costs can be both variable and fixed. They're not just variable. And so you end up with a different number. The reason gross margins suck for trying to fix a business, trying to make more money, trying to think about and make management decisions, the reason they suck is because gross margin percentages are sensitive to volume, okay? Because there's a variable component which is not sensitive to volume, that's why it's called variable, but there's a fixed component in your direct costs, in your cost of sales, and the fixed is not sensitive, it doesn't change with volume, and so your gross margin changes. Something has to give in that formula. For example, let's say you have $1 million in revenue and your variable costs are $600,000. Okay, so you got $1 million in revenue, your variable costs are $600,000, your fixed costs are $200,000, and out of those fixed costs, $100,000 are actually going to the cost of sales. They're direct manufacturing costs, whereas $100,000 is other stuff like general administration, and does not belong in cost of sales. Okay, so you've got $1 million in revenue, $600,000 in variable costs, $100,000 fixed costs in cost of sales, and another $100,000 of fixed costs not in cost of sales and general administration, which gives you $200,000 in profit. So your contribution margin percentage, your contribution margin is $400,000, which is the $1 million minus the $600,000 of variable costs, gives you $400,000 of contribution, which is 40% contribution margin. Okay, which most companies would like, manufacturing companies would like a 40% contribution margin. Your gross margin works out to 26.6%, right? Your $1 million minus your $600,000 in variable cost minus your $100,000 in fixed costs, and you end up with a gross margin of 26.6%. Sorry, of 30%. So contribution margin is 40%. Your gross margin in that example is 30%. But if you reduce, I won't take you through the math, but if you reduce your revenue to $750,000 instead of $1 million, so your volume has gone down, well, your contribution margin is still 40% because your variable costs are variable. But because there's a fixed cost component, your gross margin drops to 26.6%. Why? Because there's less revenue to absorb those fixed costs. Okay, so your gross margin used to be 30% at $1 million of revenue, and now is 26.6% at $750,000 of revenue. So people look at a business, and including management, and they say, wow, our gross margin is terrible, or our gross margin is great. Is that a useful way to think about the business that you're trying to improve? Well, no, it's not, because it's super sensitive. It's highly sensitive to the revenue that you're doing. And so you need to get those fixed costs out of there to be able to make some decisions and think about a company properly. Okay, so how does this apply to Novanni? If I want to know what my contribution margin is, I need to know what my variable costs are. Variable costs generally, if you're in a manufacturing entity, pretty well break down to direct materials, in this case, stainless steel, strainer parts, that sort of stuff. So direct materials, direct labor, so these are the people that are working in the factory that are on hourly, and a couple on salary, but mostly on hourly, freight, and sales commissions. Those would be the variable costs at most manufacturing companies. And those are the primary categories at Novanni Stainless. Now, are all of those entirely variable? No, but it doesn't really matter. Okay, you just do your best with this. Don't overthink it. These are the categories that I like to use. Let me give you an example. If you're not making any sinks today, are you going to lay off all of your direct labor for the day, right? So that is truly variable. Or are you going to have them do other things like a cleanup and a make work project? You're probably going to do that, okay? And that sort of makes that direct labor more fixed than variable for that particular day. This is never pure, all right? But this is the way you just need to make a call on this. It's more variable than not. So direct materials, direct labor, freight, sales, commissions, those are the things that I look at and probably are relevant to your business as well. And so what are they at Novanni? based on my July numbers. So direct materials, we are projecting in our financial model 35%. Direct materials is 35% of revenue. Now, where does that projection come from? It comes from when this company was more normalized in 17, 18, and even a little bit in 19. You can look back and you can say, yeah, that's kind of where my direct materials were running. And so we used, because we didn't have any real financial information when we bought the company, so we built our projection model out to see how this thing works, and we use 35%. Well, in July 2020, direct materials were running around 35%, somewhere close to that number. But what is my year to date for 2020? My year to date for 2020 was a whopping 48.8% direct materials as a percentage of revenue. Okay, so 35% is what I think it ought to be, and my year to date is 48.8%. Why is that? I have no idea. I don't know, but it's definitely a concern. So here are some possibilities. It is possible that when the accountants cleaned up the books from July 2019 through to May, June 2020, that a bunch of stuff from 2019 was posted in 2020 and therefore is overstating the expenses. And I would note that, for example, I think one of the months like May that I look at my model, my direct materials are 115% of revenue, which doesn't make any sense. That's obviously when they plowed a bunch of journal entries through for stuff from the past that wasn't done. So that could be one reason. Doesn't really help me trying to understand my business, obviously. I'm getting kind of gibberish information. Another reason is that you always need to understand when you look at your income statement, your profit and loss, that really what that's telling you is it's telling you why your balance sheet changed. And that's a weird way to think about it. When you look at whether a business is profitable, you often just, most people just go straight to the income statement and say, hey, there's profit, or there's not profit. And that's sort of true, but really the income statement is just explaining what happened to your balance sheet. What is a balance sheet? A balance sheet tells you what you own, what you owe, what you own, what people owe you, and how much you owe other people, right? That's what's on a balance sheet. And when you take what you own plus what people owe you, less what you owe other people, you end up with what we would call the net assets. And if that goes up, you did better this period. And if it goes down, you did worse this period. It's kind of that simple. And an income statement explains most of why you went up or down on that net asset analysis. So why is that relevant to this discussion in direct materials? Because the way you calculate the direct materials expense is really not by looking at direct materials, but rather by looking at inventory, which sits on your balance sheet. And the formula is opening inventory plus what I bought during this period less what I sold during this period, okay, is equal to my ending inventory. And the expense for direct materials is the what I sold during this period part. So you flip that formula around and you get opening inventory plus purchases minus inventory. Ending inventory is direct materials. That is how you it is how you calculate direct materials. And so if you're all of that to say, if your inventory is wrong, your direct materials is wrong. When is the last time at Novanni we counted and valued inventory? I don't know the answer to that, but that's certainly one of the possibilities as to why my year-to-date direct materials percentage isn't making a lot of sense to me. So what are my takeaways on that? I need to continue to look at direct materials as we go forward. I need to look at inventory counts and valuations and keep an eye on this and start diving into it if the numbers continue to be too high. Direct labor. Again, projections from based on historicals. In my model that was given to me, I'm projecting 14.3% direct labor to revenue. So notice that my direct materials are 35% of my revenue, whereas my direct labor is half of that, 14.3%. In July, we came out at 11% of revenue, which makes sense to me because I know that we're pushing people to do dual jobs. We're understaffed. And we need to hire a bunch. So it makes sense to me that my actual costs, we're straining the system. if you forgive the plumbing pun. We are straining the system, and so it makes sense to me that we're running lower than I think we ought to be running. But what is my year to date on direct labor? Similar issue to direct materials. My year to date is on direct labor is 21.1%, not 14.3%, which I'm budgeting, not 11% or projecting, not 11%, which is what July was, but 21.1%. Well, what are the reasons for that? I don't know. Again, but I'm worried about it. Possible reasons, the same thing. Maybe we're taking a bunch of 2019 stuff, pushing it into early 2020 when that's not where it belongs. So that's possible. It's also highly likely that, as I mentioned at the beginning of this conversation, it's highly likely that direct labor isn't as variable as we make it out to be. And so when COVID hit and revenue was way down, we weren't laying off accordingly. Eventually, we went to before I showed up, they went to a 4-day work week. And so that reduced some of those costs. But if your revenue goes way down and you don't make adjustments, you just have a bunch of guys standing around, guys and girls standing around an hourly wage, then your direct labor really wasn't variable at all. And that could explain some of my year-to-date problem on this. So that's my thinking on direct labor. Freight, I'm projecting 3.6%, year-to-date is 2.8%, which kind of makes some sense. We've switched carriers and got our pricing reduced pretty substantially. So that makes sense. Sales commissions, projecting 2% of revenue, and actual is, running around there. You pay people more than 2% to be a sales rep, but you, often, not always, but it doesn't apply to all of our revenue. So, on a blended basis, it works out to about 2%. So all of that to say that my projected variable costs are 35% direct materials, 14.3% direct labor, 3.6% freight, 2% sales commission. These are all percentage of revenue, equals a total cost of 54.9% variable cost. 54.9% of my revenue goes to variable costs, which means my contribution margin is 100 minus 0.549. My contribution margin projected is 45.1%, which most manufacturing companies would be pretty happy with that contribution margin. I'm not saying it couldn't be better, but that's a pretty acceptable, okay, pretty good, I don't know what word to put to it, contribution margin, 45%. My actual year-to-date costs are 48.8 on direct materials, 21.1 on direct labor, 2.8 on freight, 2% on sales commission. My variable costs year-to-date are 74.7%, with all of these possible errors in them, but it comes out at 74.7%, which means my contribution margin year-to-date is 25.3%. Not 45.1%, which is what I'm projecting, but 25.3%. Huge difference. And I'm going to use this as an example to explain to you why, when you're looking at making more money in a business, start with you got to stop the bleeding first in a troubled company, which we've done because we're going to restructure it and we stopped paying old debt. That's what needed to be done at Novanni. We'll talk about more about that in a minute, but here is after that, you need to look at your contribution margin. Here's an example. So let's say at Novanni that our fixed costs are $5 million. They are nowhere near $5 million. I'm using that as an example to try and illustrate the importance of contribution margin, okay? So say our fixed costs are $5 million. Well, what is my break even? I can put into my profit formula. Remember, profit is equal to revenue times contribution margin minus fixed costs, okay? If I put my profit to 0, which is break even, I can rework that formula and through the magic of algebra, and what I come up with is that fixed costs divided by your contribution margin is equal to the revenue that you need to break even. So at a 45.1% contribution margin, which is what I'm projecting, and $5 million of fixed costs, which is a made-up number, how much revenue would I need? 5 million divided by 0.451 is equal to 11 million of revenue would be required for this company to break even with that set of assumptions. My year-to-date contribution margin is 25.3%. How much revenue would I need? How much revenue would I need to break even with $5 million of fixed costs and 25.3% contribution margin. It's going to be more than 11 million, right? If you plug it into the formula, it's 19.8 million. Basically $20 million to break even. 20 million, not 11 million, 20 million, just based on this swing in your contribution margin. It's a massive issue. It's how you lose money. It's how you make money. The first thing that you ought to be looking at is your contribution margin, which means your variable cost, which means pricing, right? If you charge more for your goods or your service, you're going to have higher margin. And reducing your contribution margin, reducing your variable expenses, which at Novanni and most manufacturing entities means direct materials, direct labor, and then some of the smaller stuff like freight. And every percentage point makes a massive difference. I've just illustrated for you the sensitivity of that. So what do I do? What do I do with this information? I mean, I need to track my contribution margin. I need to see if I'm trending closer to my projection than I am to my year to date, which has this massive variance. For now in my head, I don't know where we're going to end up in reality. I'm going to guess it's 35%, which I can live with, okay? But I'm guessing that. I don't know. I need better information. The information I have right now isn't leading me in any particular direction other than some early on conclusions that this is an issue that I need to stay on top of. And in my head, I'm thinking if I start out as a troubled business at 35% contribution margin, I can live with that. And there's lots of ways that we can start to improve that. Okay, so I'm going to reevaluate when I see my August numbers, which I should see in a couple of weeks, and I will share that with you. Now, here's another conclusion. I've told you on prior episodes that I've been working through I've been going through a listening tour, I like to call it. And what that means is you just start talking to your employees. I've been sitting down one by one for an hour. I haven't done one in a couple of weeks because it's been, the dog days of summer, but we're going to pick that up again now in September. And it might take me a year to talk to everybody in the company. But I'm just sitting down for an hour over Zoom or in person when I'm there and just having an open discussion. This is your opportunity as an employee to tell me, educate me. What do you do for, what is your job? What do we expect from you? But more importantly, what is wrong with Novanni Stainless? What is good about Novanni Stainless, and how can we make the business better? How can we make your life better, right? And if you do that, you don't have to believe every single thing your employee tells you, but you're going to find a pattern. You're going to find commonality really quick, because a lot of this stuff, a lot of the problems in every business, everybody knows what they are. They just don't know how to fix it, or they don't have the authority to fix it, or there's no consensus. And if you just ask your senior managers, you're never going to get the answer, okay? Because it's going through their filter, and they've already said, yeah, I've heard that's an issue. In their mind, they've said, yeah, I know that's an issue, but I'm not going to raise it as an issue because I know it doesn't count, or there's nothing I can do about it, so I'm going to focus on these things instead. You don't want that filter, okay? You want to talk to your people, everybody, directly, and start doing that and start getting their perceptions on things, because people are smart, and if you respect them and if you're empathetic, you're going to get good answers, okay? So what have I learned about Novanni? We've talked about this in prior shows, but one thing I learned about in terms of the employees is that we have a ton of turnover. We have lost a lot of experienced people. We're having trouble recruiting additions to replace those experienced people that left. As a result, we have shortages. We have people manning 2 stations. We're taking some shortcuts. We're overusing temps, which is an evil. I hate temp agencies. And you're it's not that they're not good people, but you're getting people that are going to be there for a day or 3 days. They're not trained. They don't really care. They don't know what the business is. They're just like doing this and doing that. And then they're going home with their paycheck, and God bless them. But to build a business, and you're overpaying for them. You're paying 1.5, 2 times what you would pay somebody else by the time you add it all in. And why are we losing people? Why are we losing our senior people? Why are we overusing temps? Well, our pay rates may be some of it. We may not be competitive in the marketplace. During COVID, Prior management made the hard decision of moving to a 4-day work week to try to preserve some jobs, and that was, if you're making minimum wage or you're making, I don't know, $18, $20 an hour, you start taking a fifth of your week out. Well, that's a pretty big hit on the family. So I'm not sure I like that decision. I might have gone about it differently. But anyways, I'm not going to second guess people. That was the decision they made, and I respect that. But it certainly references part of the problem for why people have left. And so, I need to start addressing this issue. And now that I have some variable costs, some contribution margin information, I have a little bit of data, as crappy as it is, to start helping me think through that. And what I can see is that my direct labor at 14% or 17% or 20% of my revenue is not my biggest cost. It's a significant cost, but it's not my biggest cost. And if I were to raise that direct labor a little bit, it wouldn't have a massive impact on my contribution margin. Okay, so I think intuitively that I can provide a small hourly raise to those that are making hourly wages at Novanni, and I think that we can afford to do that. Now, is that going to increase my direct labor percentage, my variable costs, and therefore decrease my contribution? Yeah, on the surface, like if it goes up, if the direct labor goes up X%, my contribution goes down. I mean, that's just simple. Everybody can understand that. But what would the ultimate outcome be on my contribution margin and on my direct labor percentage and on my direct materials percentage? I would argue that we don't really know. I mean, it's obvious if we give people a raise, it's going to be more costly. Like, that's obvious. But if we are able to fix the retention issue, if we're able to recruit better, we have more experienced staff. Ultimately, what do more experienced staff do? Well, their productivity goes up. You produce more units. You have more revenue with the same direct labor, then, right, because they're producing more, your productivity goes up. So you have the same direct labor costs and your revenue goes up. Well, then your contribution margin percentage goes up. That should mitigate the raise, possibly. That's one outcome that could happen. If you have more experienced staff, will you be reducing waste, errors, quality issues, reruns? And if any of that's true, then your direct materials use would go down, and therefore your direct materials percentage of revenue would decrease and your contribution margin percentage would increase. So the raise increases your direct labor costs, but maybe you get better productivity, and maybe you reduce your scrappage and reruns and all that sort of stuff, and your direct materials go down. Possible, right? So what would a raise accomplish? An hourly raise in the back accomplish at Novanni? Will it help recruiting? Probably, right? If we're not competitive, which I believe we're not. There's a bigger city center of Barrie, not too far away. People that live in our area could drive to Barrie, drive to maybe Aurelia. I don't know what the other cities are, and maybe get a couple of dollars more. And we have to compete with that. So that's an issue. It'll probably help with recruiting. Would it help with retention? Maybe. I think the 4-day work week was a bigger issue than the pay scale, but my experience is that it's really the soft issues and the morale that impact retention, people wanting to leave. So for example, pride in your work area, the back of Novanni has been a mess. There hasn't been a sanitation staff. We just hired somebody, by the way. I think they start next week, so I'm excited about that. Clarity of role. What is your job description? You're trying to run around, do 2 or 3 things because we're understaffed. I think those things have more of an impact on retention, but certainly pay might have something to do with it as well. Would a raise help morale? No, it doesn't help morale. It's the soft issues that help morale. It's the pride in your team and your organization that help morale. I think there's all sorts of organizational science around that particular issue. If you're underpaid and can't afford to eat, that definitely hurts morale, right? That doesn't make you a happy camper. So we have to be mindful of that. So it could help recruiting, maybe help retention, probably doesn't help morale. There's other ways that we need to help morale, and I think that's already happening, by the way. Here's a big one for me. Does it communicate that we're starting to win? Hell yeah, it does, okay? The biggest thing, that's why this whole show is a show about winning momentum in business and in life. You can't wake up every day and lose. You have to start winning. You have to start small and start winning if you want to make change. We're doing that at Novanni. How do I persuade and communicate a little bit that that's helping? Here's a good way to do it. It's so important to show progress, to show change, to show momentum. You don't have to fix everything to change attitudes. You have to show a direction. You have to show a positive direction and gain winning momentum. We're coming out of a change of control. I bought the business. What the hell is that all about? Who is this guy? I wasn't so keen on the last people, perhaps, or maybe I love the last people, but change brings risk. Like if you're an employee, if you're anybody, change brings risk. We're coming out of COVID. Are we coming out of COVID? I don't know. What's management's view about that? We were on a 4-day work week. Now we're on a 5-day work week. Now they're asking me to do overtime, and I don't want to do overtime, right? You need to start showing progress and momentum. What an awesome way to do that. It reduces chaos. It sends a message that we're reducing chaos. What does chaos mean? I think about the world in chaos and order. Every troubled company is in terrible chaos. Okay, and when you're in chaos, it's change. Chaos is change, a lack of focus, making stupid decisions, not making decisions, not being on top of things. Every troubled company is chaotic and therefore stressful and therefore loses money. If you have too much order, okay, that is uninteresting, it's not creative, and it ends up being death. All right, there's the chaos and order applied to the business model. You need to be somewhere in the middle. We are way too chaotic. We need to communicate to our employees that at Novanni, as a management team, we're starting to get our act together. It's not going to be fixed anytime soon. It's not going to be order anytime soon, but we're on our way there. We're starting to fix things. We're being less chaotic, and we're being more purposeful, and we're starting to have winning momentum. So it does that. I think a raise accomplishes that big time. It may reduce the cost of errors and scrap our direct materials, as I said before. It may not impact hugely our contribution margin because there could be benefits to this, as I said before, both on direct materials and on productivity. So we'll have to, if we do this, we'll have to see how that works out. So I asked this by chat message to some of my senior managers at Novanni yesterday, and the response I got was that it raises the cost per sync. Okay, and I need to think about that. And that's just true. If there's a raise going to hourly people, then it raises the cost per sync, and we only have so much margin per sync. And the answer to that, I believe, is yes, it does raise the cost per sync. It raises the cost per sync if you assume that everything else is static, that there's no benefit to Novanni at all from an employee raise, right? That the raise only helps the hourly worker. It does nothing for Novanni, all right? If that's what you think, then it raises the cost per sync, okay? But I don't believe there's no benefit to Novanni. I think that retaining people helps production, productivity. I think that retaining people and being able to recruit fixes a lot of our problems in the back. I think that retaining people and being able to recruit lessens our reliance on temp labor, and all those things are a benefit to Novanni, not to the employee, but to Novanni, the business, and therefore it may actually lower our cost per sync ultimately. I don't know, time will tell. I've concluded this: there will be a raise to hourly employees, and it will be soon. It will not be, I know a bunch of you are listening to this. It's not going to be a lot. Okay, there's not a pot of gold. I need to figure that out, but there will be a raise to some, at least, hourly employees. So who are those hourly employees going to be? I don't know. If it's going to be everybody, if it's going to be some of them, how are we going to handle that? I need to sort through that. How much will the raise be? As I said, it's not going to be a ton, but I need to work through that in the next week. We'll see where we get to, but I'm going to be at Novanni in 2 weeks. and I'm going to address the employees again because I promised to do that monthly, and I have a bunch of work to do there. And by that time that I get there, we will know what that raise is going to be and to whom it applies. All right, I'm an hour into this show. I have a bunch more to talk about. So I'm going to skip that for another episode. And I'm going to sign off now. I think that was enough. I'm excited about Novanni. I'm excited about my decision with respect to Thomas and the cancel culture side of this. It's been a productive week. Thank you everybody so much for listening. This has been Martinis with Scott. We are on YouTube, Apple Podcasts, Spotify. Please take a listen to prior shows. Please subscribe so you don't miss anything going forward. Thank you.